Well, the Federal Reserve is floating a trial balloon in the Wall Street Journal yesterday and today. I guess it's an ongoing sort of a balloon that's been floating, and they're waiting for it to be shot down or whether or not it might actually pass. And of course, what I'm alluding to is the proposal that the Federal Reserve will begin lending directly to hedge funds. Now, those of you who learned anything at all about the Federal Reserve in school, what you probably learned was that the Fed was set up in 1914 to be the lender of last resort because we had this unstable financial system and all this. They tell you a lot of lies about it, and how the job of the Fed is essentially to make sure that folks who have money in the bank that they don't lose their money. That's basically what the Fed does, and in doing so, it also prevents us from having these such extreme economic cycles of ups and downs. And now in reality, of course, it makes all of that much, much worse. And essentially, it's an institution that just sort of gives handouts to the uber rich. That's how a lot of us dissidents tend to see it, the end the Fed crowd. Or as one of my favorite market commentators, Sven Henrik, likes to put it, that central banking is socialism for the top 1%. Because essentially what the Fed does is that they always will either let the market do what it wants, or they will intervene in the market to ensure that things always go the way of the top 1%. And this is not an unfair characterization at all. You don't have to be some kind of Bernie bro. In fact, you tend to be quite the opposite if you really study the Fed too closely, because of course the Fed is a government institution. It was created by Congress, and its members are appointed by the president. And thus, by extension, the Fed is entirely controlled by special interests. In this case, the special interest of the bankers and the financiers. And increasingly now, the hedge fund managers, which are more of a modern phenomenon. Hedge fund managers didn't really exist when the Fed was created. But they've become closer to the Fed in the last few years now that hedge funds are using the repo markets, which repo is short for repurchase agreements. I talked about the repo markets back in when all of this was playing out in, September, I think was the repocalypse. Apparently, hedge funds played a big role in that repocalypse and why it could have been so bad, because hedge funds now are using the repo market to lever up all the assets that they have under management to get higher returns. And how that basically works is that the hedge funds take the money that their clients give them to invest for them, and then they use that money as collateral to get loans from the Fed, and then they take the money that they borrowed, because they're able to borrow more than, they're able to borrow a larger amount than what they actually have from their clients. So then they can go and invest all of that money that they borrowed, and then they're able to reap higher returns for their investors. So let's say that they're, between all their investors, they have $20 billion that they gave them to invest for them. Well, if they're able to lever that up, and use that as collateral to borrow, $200 billion, well, then their investors are making interest not on the $20 billion that they invested with the fund, but rather on $200 billion. And in the era of ultra-low interest rates, you would be a fool not to do this, because the cost to borrow money in real terms is below zero, or right around zero. It kind of varies. So because the Fed has consistently kept interest rates so low for so long and has signaled to the market that pretty much they'll never raise rates, it makes sense to borrow money at these extremely low interest rates, go and invest them in the stock market, and make really high returns, and then you have more than enough to pay back your loans, and you're going to make much more money than you would just have been buying stocks with the money that you already had. Now, there is some downside risk to this, however, and the risk is that you have something like what happened in September, a repocalypse, to where the repo rate suddenly spikes over 10%, and you don't have enough money to pay your bills and to run your little scheme that you've got going. Now, this is very opaque how this all works, so I can't explain in the greatest detail how all of this works exactly, but because the nature of the repo market is that it's an overnight loan, meaning that you borrow money today and you have to pay it back tomorrow. If the rate suddenly spikes, you need to borrow money, You can't just wait another day or a few days until the rate goes back down, because you probably have got yourself geared to this pattern of borrowing and paying back money every day. And so, since I don't work at one of these big hedge funds like Citadel, I can't tell you exactly how their strategy works and how they use the repo market mechanically, what the mechanics are of that. But that's basically the problem. It's not that they borrow money when it's cheap. It's that they borrow money. They have to borrow. Money has to be cheap constantly for them to continually keep borrowing and keep their all their positions levered up. And what happens when if the repo rate were to spike and all of a sudden their strategy didn't make any sense anymore and they couldn't do all that, what you would have is mass liquidation of stocks, because they would have to sell off all the stocks that they have, from levering up their assets. To pay down all these loans and to deleverage. And of course, these hedge funds own a lot of stock. Like I said, many billions of dollars worth. And so, in doing so, in liquidating their funds and deleveraging because there was a sudden spike in the repo market, they would probably trigger a broader market sell-off. And this is something that the Fed just cannot allow, not because the Fed directly wants to prop up the stock market, but because the Fed knows that if they don't prop up the stock market, everything else will come crashing down with it, because that's how they set things up after 2008. You folks might remember, well, I don't know, not a lot of people probably remember this, but Paul Krugman had a rather now infamous column in the New York Times after the crash of the dot-com bubble in like 2000, 2001, and he said, hey, Alan Greenspan should replace the dot-com bubble with a housing bubble. And it turns out that's exactly what Alan Greenspan did. And then finally, when the housing bubble crashed, and then that spread into contagion to the rest of the economy, and we went into a recession for 2008, Ben Bernanke replaced the housing bubble with a stock market bubble. Although it's not really just a stock market bubble. The stock market is the most visible part of the bubble. It really is a bubble in all risk assets. And of course, the way he did that was by keeping interest rates super ultra low and encouraging people to lever up. And to take a lot more risk than they otherwise would. And so back to the reason why the Fed can't let this bubble burst is because the stock market really is a great barometer of consumer confidence. A great, when people see headlines that the stock market's going up every day, not only do people who own stocks who have 401ks think, oh, well, I've got more money saved away for retirement, so I can spend more now when I'm younger, and I don't have to save as much because I'm going to have so much more money. I have so much more money now put away for when I'm retired, so I can afford to spend now. And in the short term, that boosts GDP. But also, people who don't own stocks just think if they see the stock market going up every day, it gives them the impression that the economy is doing better overall, and that they don't have to worry as much about their financial position. They don't have to, if like, let's say you work as a contractor or something, and you see the stock market's going up every day, you think, oh, well, the economy is doing pretty well right now. I probably don't have to worry too much about finding my next job after I finish, working on whatever house I'm doing right now. And so it's a confidence game. Therefore, if the Fed, did nothing about the repo market, and they let, leaving aside what would happen to the banks, if they let the hedge funds delever now and liquidate all of these assets that they've purchased by levering up, then and that leads to a broader stock market sell-off, well, then you lose all that consumer confidence and the wealth effect, and people stop spending so much money because they realize, oh, gee, the economy's not as good as I thought it was. And, they put away some money for a rainy day, which in the short term, again, is bad for GDP, which is why GDP is not the best metric of the health of the economy. All GDP is really is a measure of spending. And so that's why now the Fed wants to go around and lend directly to these hedge funds to make sure that nothing bad ever happens to them and that they don't have any volatility to deal with when it comes to their leverage. They want to have total access to liquidity given to these hedge funds and to give them front and center treatment. Now, this is basically what the hedge funds already have, because they do have access to the repo markets, though it's indirect. They have to go through some banks, and then the banks go and get the repo loans for them, and then they go through a middleman. But the hedge funds do in a way, they are accessing these funds in the repo market. Having direct access would just make things a little easier for them and the Fed. And so it makes sense to do it considering the current climate and what's going on and how the system is working. They're pretty much already involved in the repo market, so why not let them have a direct phone line to the Federal Reserve? The only problem really is not a practical one. It is a public relations problem. And that's, of course, that if you hear that the Fed is giving special treatment and essentially giving free money to the billionaire hedge funds, that doesn't look too good. It looks like, almost that the Fed is just a tool of the uber rich, which of course people like me know that that's true anyway. But the ordinary people, who 99% of them have never heard of the Fed, but those who have heard of the Fed think that the Fed is this great guardian who's helping us and protecting our financial system from collapse and, helping ordinary people. Because, gee, if we didn't bail out the banks, well, then you'd lose all your deposits. But the idea of the Federal Reserve directly bailing out the hedge funds, which is what would happen if anything bad happened. The hedge funds could just go to the Fed and say, hey, this is how much money we need. And the Fed would say, okay, here you go. It's at 0% interest rate. That just might smell a little fishy to the average person. People might start to question the system. They might start losing confidence in their bettors. They might not. They might start to realize that, hey, maybe the system's rigged against me and in favor of more powerful people. Maybe America is not such a great meritocratic utopia. And so for that reason, I actually support the Fed directly giving free money to hedge funds and bailing them out in the case of the next crisis, because then things will become a little more clear to people. It was already bad enough when the people saw the government and the Fed bailing out all the big banks. Now they're going to bail out, at least in the case of bailing out the big banks, you knew in your heart that was, not helping ordinary people, but they could at least still make the case that, oh, well, we have to do this because ordinary people have money in these banks. Ordinary people do not have money in hedge funds. Only the, top 1% of the 1% have any money in a hedge fund like Citadel. Not even normal people who have enough money to put away something in a 401k are going to benefit at all from, directly from the Fed bailing out hedge funds. And so when it inevitably happens, I want it to be as blatant as possible so that people understand what's going on, even though you're still going to have all of the Fed apologists like Steve Leisman in the media trying to explain this away and talk about, why this is still all good and altruistic and how this helps all of us Americans. A few people, at least, will be able to see through the BS and realize once and for all that the Fed is not their friend. It is quite the opposite. They, set up this system and make it very unstable and risk all of us losing our jobs just for the sake of helping, the most well-connected people, the folks who have influence over the Fed, make a few extra dollars every cycle. So with that said, if you gained anything of value out of this video, I'd appreciate you clicking that like button and sharing this video. If you haven't already, please do subscribe because I do upload every day and I'd hate to have you miss one. So I'll see you folks back here tomorrow.